Hey, what's up, everybody? Thank you for checking out the Average Joe Investing channel. My name is Drew, and today I'm going to talk to you about ETFs. So, ETFs to me are an integral part with starting out your investment strategy. So, for this whole first few videos, the one thing I wanted to talk about are safe investments. We can get into stocks and specific stocks and options and things like that. But the one thing that I want to bring to that I feel like YouTube is lacking is I want to bring to you safe investment. Because when getting into the stock market, you're dealing not with the markets and what's going on with the markets, you're dealing with what's going on in your head. Just like me and just like a multitude of people that I know and have met throughout my life when I've talked about stocks and investing, their biggest fear is, what if I lose my money? And so what I want to bring to the table is a quick, easy way to not have to risk that investment. So with that, let's jump right on in. I'll get you right on over to what the definition of an ETF. I'll as well bring to you ETFs and their structures and what they bring to the table and their fees associated with them. So without further ado, let's jump right in. All right, so as I stated, today we're going to talk about ETFs. And before we can talk about an ETF, we have to know exactly what an ETF is. So what is an ETF? ETF is an exchange-traded fund. Now, what is an exchange-traded fund? Well, an exchange-traded fund is a type of pooled investment security that operates much like a mutual fund. Typically, ETFs will track a particular sector or commodity or other assets, but unlike mutual funds, ETFs can be purchased or sold on the stock exchange the same way a regular stock. So the reason why I like ETFs is because it can be traded just like a stock. And what do I mean by that? So at 9:30, the stock market will open up. You can purchase an ETF, just like you would a stock, and it would show up in your portfolio instantaneously or whenever it was purchased, depending upon who you're using. And then, say you wanted to sell at noon, or you wanted to sell the next day. Unlike a mutual fund, you can sell it instantaneously, and once the security is sold, you then have the money. You're not at the same risk as a mutual fund where you'll have to wait period of time for the security to sell and to get your money. So continuing on, an ETF can be structured to track anything from the price of an individual commodity or a large diverse collection of securities. So with me, when I'm looking for an ETF, I'm looking for an ETF that holds a multitude of securities, either in a specific sector or following an index. So generally in an ETF, let's just say it's made up of 30 stocks. If you have 10 stocks that are negative that day, they just had a bad day, generally you can have the other 20 either be at break even or gainers for the day, which takes your risk tolerance to an even lower level because you're not losing a ton in one day, but you can gain. And so being able to not lose as much money in one day is extremely, I don't want to say satisfying, but it's good for your mental psyche because the whole investing game is just running with your mind. If you haven't gone to school for it and you don't know what's happening and you're just getting into it, your mind is going to take over you. When you see that first red day, you're going to be scared to death. And purchasing an ETF, it's not going to take that away, but it's going to show you, it's going to build your tolerance because you're not going to lose a ton of money in a day. And generally, you're not going to lose all your money at all because ETFs and mutual funds are generally managed by either a company or a person, whether it's actively or not. There's someone checking in to swap out funds that aren't doing well, to swap out securities that aren't doing well, because the only way that ETF can survive is if it is generating a return. Okay, so continuing on, what type of ETFs are out there? So you have a multitude of types, just like you have a multitude of mutual funds. You can buy bond ETFs, and these focus around the bond markets. You can buy stock ETFs, which are generally what I buy, and they are comprised of a multitude of securities within the stock market, stocks within the stock market. As well, you can have industry and sectors. Okay, so that's exactly what I was just talking about. Commodities, as their name indicates, commodity ETFs invest in commodities, including crude oil and gold. So, say those of you who are still into oil and gold, you can invest in commodities. Currencies are pooled investment vehicles that track performance of currency pairs consisting of domestic and foreign currencies. Currency ETFs serve multiple purposes. They can be used to speculate on prices of currencies based on political and economic development for a country. They are also used to diversify a portfolio or as a hedge against volatility in Forex markets by importers and exporters. You have inverse ETFs. So inverse ETFs attempt to earn gains from stock declines by shorting stocks. Okay, so basically as if you were to do a put or a call, it's option ETF. So in this case, it's by shorting. You have leveraged ETFs seek to return some multiples, e.g. 2 to 3 times on their return of underlying investments. For instance, if the S&P 500 rises 1%, a 2x leverage S&P 500 ETF will return 2%. Okay, so these are your double leverage or triple leverage ETFs. And so they're going to double or triple what the ETF does. So if it loses 1%, you are going to lose 2% or 3%. So how to begin investing in ETFs? This is very simple. Whatever platform you use, whether it be Webull, Fidelity, Schwab, Vanguard, Robinhood, they will offer a multitude of ETFs throughout the stock exchange in which you'll be able to purchase. You will just then need to go through and figure out what sector, commodity, what if you want to do 2x, 3x leverage ETFs. And once you have that investing platform, you can then invest into that. So without further ado, the next thing I want to hit on, because I don't want to make these videos long and drawn out, is I want to hit on some ETFs that are available and understanding their growth rates and how to read that and their fees. Because with everything, there is a fee. If it's actively managed or managed by a company, there will be a fee. And you need to think about that before you invest into an ETF. But yeah, so in this case, let's just check out a couple of Fidelity ETFs. So let's choose an asset class. So in this case, I will choose, let's go, US equities. I want large growth. And let's see what the expense ratios are for these. Okay, perfect. So you have the Fidelity Blue Chip Growth Fund. Its year to date is down. Obviously, everything this year is down, but its 1 year is at a 7% return. 3 year is at a 28% return. Expense ratio of 0.79%. As well, we have the FOCPX, which I have invested in before. It's a large growth portfolio. I did actually remove myself just due to the declines this year. But it's a negative 14.59% this year, 12-year, or 12% within the 1 year, 28 within the 3 year, 24 within the 5 year, and 20 within the 10 year. And as you can see, every investment company or brokerage has their own, and they're generally actively managed, and they offer great returns that generally outdo the market. I mean, at 28%, you can't beat that within a year. It has an expense ratio, though, of 0.8%. So yeah, and let's actually check out what it offers. So that's something else that you want to see. What are its highest securities? So in this case, you can see that it is a mega cap or large growth. So you have Microsoft, Apple, Google, Alphabet, Amazon, Facebook, Meta now, Nvidia, Alphabet, Marvell Technologies, Netflix, as well as 171 other holdings. So this just furthers my point on what it brings to the table. If you were to go ahead and invest in Microsoft today, let's just click that. Microsoft is $287 a share. That is, I mean, that's a lot of money. And for most of us who are starting out, we're not able to bring that much money to the table. I mean, even if you started out with $1,000, you would own 3 shares, which is not a lot. But in this case, when you buy into this portfolio, which is right around, if you were to buy in today, it would cost you $16.74 for a share. If you came in with $1,000, you would be able to own, so in this case, you'd be able to own 90 shares of this company. And right here, we can track it. So this is tracking the NASDAQ composite. And as you can see, this portfolio has outdone. So if you were to invest $10,000 in 2012, you would be right up to about $62,000 today. And if you were to invest in the NASDAQ, you would be up at $56,000, and in another large growth blended ETF, $41,000. And all this information you're going to need to know when you're risking your money. And in this case, like I stated, it's a lot less of a risk, because if let's just say Google and Nvidia do bad one day, you have Microsoft, Apple, Google, Amazon to pick you up that day. Let's check out another one. Let's see. This is actually kind of fun. So let's see the Blue Chip Growth Fund. So it's $153 a share. It has an expense ratio of a 0.79%, and it invests once again in Apple, Microsoft, Amazon. But this one you get Tesla, Lowe's, and 444 other holdings as well. And if you invest in Fidelity, it's real simple. You're able to see the breakdown of the portfolio. So information and technology, it holds 39%. Consumer discretionary is 28%. Communications 14%, healthcare 6%, industrials, energy, financials, materials, consumer staples. It's even got real estate, utilities, all within. You can see on the style chart, it is a growth chart. As well, it gives you this risk category over here, which I believe is a Morningstar risk category. You are slightly higher in this case. Its expenses are average, but its rate of returns high, which is great because, I mean, at the end of the day, isn't that what we are looking for? We are looking to be able to grow our money. And what better way than being able to purchase a numerous amount of securities for a small or a lower fee? We can check out things from performance to risk within the year. It compares it to the Russell 1000 growth as well as large growth. It gives it a Morningstar ranking. So this is exactly why I like Fidelity in this case, but as well, any brokerage will have breakdowns of all of this. As well, we can find out who the fund manager is, how long they've managed this fund. So this manager has managed this since 2009. It shows you their portfolio of funds that they currently manage and have managed. You can see previous, and their education, which to me is just great. I mean, you really want to know that these people are not only taking care of you and your investment, but as well that they have the proper education. So with that, I think we can just end that for today. All right, perfect. So with that, just summarizing today, we learned that ETFs are exchange traded funds. They are traded just like stock. They are generally brought up of a multitude of securities in a certain sector or commodity or whatever the case may be. As well, it allows you to diversify with a lower amount of money or a higher amount of money, whatever the case may be. But I know when I started investing with my first $100, it was nice to be able to have a security that I could buy for $12 a share, own a multitude of shares, and as well have a broad reach within the market. And that is exactly why ETFs are great. They're great because the risk is a whole lot less than it just buying single securities. The research is pretty much done for you right there. You're able to hold a multitude of stocks within that one portfolio, and your money goes a longer way in the long run. Overall, ETFs, great start to your investment. It helps build that mentality of staying with the market, understanding the market. It also gives you time to further your research and build your investment strategy. So if I've done anything right here, if I've been able to explain anything better to you, if I've been able to show you anything, please hit that thumbs up. Make sure you subscribe. If you have any further questions, leave them down in the comment section. I will make sure that I get to most, if not all, comments. As well, I'm building a Discord channel, a Patreon, if you'd like to support me. With that, thank you again for checking out Average Joe Investing. I'll look for you next time. Peace.